All right. Welcome back to another episode of the Real Estate Investing Club, and happy Friday, everybody. Bringing that Friday energy. I hope you guys are having an absolutely fantastic day wherever you are. It is a good day because we got Jeremy Friedman with us on the podcast. Jeremy invests in multi-tenant value-add flex industrial, one of the assets that I'm super keen on. They have over almost 900,000 square feet in 6 states. He is from I should have had this pulled up already. Stoic Partners, Stoic Equity Partners. Apologize about that. But Jeremy, I'm super excited to jump into this. Thank you for hopping on the show.
Man, really excited to be here, Gabe. Thanks for having me.
Absolutely. I told you before we got on here, we always like starting with stories and hearing how people got to where they are. You guys have quite the portfolio there, so I'm sure you got a good story. Why don't you take us to the beginning and tell us how'd you get started?
So I like to think of my career as 3 different lifetimes. And so my first lifetime was I was an investment banker. I was an institutional bond broker in Memphis, Tennessee. And our firm got bought out. I moved to the Gulf Coast to raise a family down in Fairhope, Alabama. We're on the eastern shore of Mobile Bay. A friend talked me into starting a home building company.
Oh, wow.
Right in 2006, literally the peak of the home building market. So rode that all the way through, very painfully through the whole financial crisis. Did a lot of green certified and really pivoted a lot. Went from a production home builder into custom. Did commercial, some lead. That just really pivoted every which way until 2011, when I finally we had a little thing called the oil spill down here in the Gulf of Mexico in 2010. Yeah, so I finally, after battling the financial crisis and the oil spill, finally threw in the towel in 2011. Went to work for a single tenant net lease retail developer that I knew out of Tuscaloosa, Alabama. And we, after working there for a few years, moved into brokerage, which is where I met my partner, my current partner in Stoic Equity Partners. His name is Grant Reaves. He and I were both brokers together in a regional firm. He specialized in hospitality brokerage, and I specialized in single tenant net lease retail. We kind of went our separate ways for a while. I started my own brokerage. He went with Marcus and Millichap. And we came back together in 21 to form Stoic Equity Partners. We had always wanted to get onto the principal side of things. Brokerage is fantastic, but we, for whatever reason, decided we wanted to get into the principal side, and had enough time with COVID to the phone stopped ringing just long enough to hatch the plan for Stoic.
I like that.
And we did. And we started in self-storage, like we mentioned. And we have 4 storage assets. We did an adaptive reuse. We did a ground up development. We did an expansion, and we bought a pretty stabilized core plus type deal. But about that time, we started seeing the economics get really tough with storage. And we're in a high growth area, lots of new supply coming in. So we kind of saw the supply and demand imbalance, and saw too much supply. Interest rates were getting higher. We were having a hard time underwriting things, and we made the pivot to multi-tenant flex because we were able to achieve the yield we wanted to. Supply and demand is the opposite. So there's been no new supply of flex for the last 30 years, and lots of demand in these growing markets, still well below market rent, rents well below where you need them to be to develop new product. And we just saw a lot of room for growth there. So that's how we ultimately decided on flex industrial.
Nice. Yeah, and I like the arc of your career, because I feel like everybody in real estate, it's never linear. We never wherever we end up is never where we start. We start at point A and then we go up and down and left and right, and then we end up where we are. And your career sounds to be the same. I always
Yeah.
like people who have been on the brokerage side and then also on the investing equity side. I always like to ask your opinion because I have almost got my broker's license like 100 times since I got into real estate, but I've never actually done it. How do you people that are investing in real estate, like, do you suggest that they get a brokerage license, or is that something that is not necessary? I don't know. What's your take on that?
Good question. I I would say currently with Stoic, maybe 10% of the deals we do, we get I'll take a commission on as the broker.
Okay.
Most everything we tend to do is off market
Mm,
through brokers, and so let me explain that. I mean that's part of, I believe, our secret sauce. Grant and I both coming from the brokerage world. What we've done is we've gone out and built a broker network in all of these markets that we want to invest in, and we there are in Flex Industrial, there are really one to two major players in each market. So it's not like we go to a market, say a Jackson, Mississippi, and there's 20, 30 brokers to choose from. There's really just a couple of major players in the market. And so what we do is we go in, we database a market. We develop a relationship with one of the main players. We tell them which assets in their market we're interested in. They have relationships with all of the owners of those assets already because they've leased brought them tenants or maybe sold them the property, whatever, but they already have relationships where it'd be really hard for us to develop a new relationship. It'd certainly be a long cycle for us to develop a relationship with a seller. The brokers work really hard for us because once we purchase those assets, we also hire them, typically the same broker, to manage the properties. So third
mm,
party property management, we hire them to do the leasing on the properties. And potentially they could sell the property for us when we exit, if that's the right fit at that time for brokerage. So with that being said, most of the properties we're buying are off market through a broker.
you're a
We're
broker.
not going to try to insert ourselves in there for a brokerage fee, right?
Yeah.
We we also, a lot of investment sales brokers don't offer a co-broke fee. So it's,
Mm,
even in storage, those guys are not offering a co-broke fee. So we would put ourselves at a disadvantage if we tried to get a commission.
yeah.
So there are exceptions where there are properties that have been listed and they have offering a co-broke, and by golly, we're not going to
Say no.
not we're not going to say no. So we do use our brokerage license for that, in those situations. But
On the
I-
whole, it
you know,
sounds like it's not a true advantage. I mean, it sounds like you can operate sufficiently without having a brokerage license.
and I think you're probably better off because there are a lot more regulations on brokers,
Mm-hmm.
and that you've got to be careful with disclosures, and it's not too cumbersome, but there are some regulations that need to be taken into consideration if you're going to if you have your broker's license, and you're buying and selling properties. So
Yeah.
they're I would say if your main goal is to be investing in real estate, then no.
Yeah.
If you want to also broker properties, then that's a whole different conversation. But
Yeah. Yeah. And I feel like an idiot because I just recently realized how valuable getting off market deals through brokers is. Everybody
yeah,
that I've had on the podcast has said, one of the best avenues that they get good deals is through brokers. But ever since I started in commercial, I always did off market. Like we would get lists, skip trace them, call them, cold call, all that kind of stuff, send letters,
Yeah.
and it worked to an extent. But a couple months ago, I started a thorough, I guess, outreach program to get in contact with brokers, and we already have two RV parks that we're getting under contract off market. They through brokers, but they hadn't actually hit the market yet. And I had no idea. I should have known, but finding deals through brokers is definitely a good strategy to find good deals. I always thought that if it was through a broker, it wasn't going to be a good deal, but that's definitely not the case.
No, I think you're on to something now. I mean, the brokers are, I mean, it's just leveraging the amount of contacts, and these guys have most likely those RV parks, that broker probably started talking to those sellers years
Years ago.
ago,
Yeah.
and finally they're ready to sell.
Yeah.
And if you could spend all day there, every day cold calling owners of properties, and take, 6 months from now, you might get one of them on the phone, get Bob on the phone and he hangs up on you. You can keep calling Bob, and 2 years later, Bob's comfortable with you. But the broker's been talking to Bob for years and knows
Yeah.
Bob, and they've done business, and he vouches for you, and it's a much quicker situation. So
Yeah. Yep. Absolutely. So it sounds like, I mean, you guys are reaching out through brokers. For the flex side, is your main strategy buying, or are you also consider building?
So part of our whole thesis with Flex is that we can buy it below replacement cost.
You
Rents
can
are
buy it
low.
below replacement cost. Interesting. Okay.
Correct. So our average across our portfolio, our average currently is $93 per square foot. You cannot
Wow,
build it
that
for
seems
that.
really low. Yeah.
You can build it more in the 140 to 160 range, depending on the specific site and the product. But I mean, we've bought as low as 63. We bought up right at 90,000 square feet in Atlanta, or McDonough, an Atlanta suburb, for $63 a square foot. Those rents were in the $5 per square foot range, gross,
Mhm.
modified gross. And we turned around, we've already signed 2 renewals now at $12 triple net. So
Wow.
to give you an idea, their rents basically quadrupled.
Yeah.
And what we find is there are a lot of uh, legacy owners out there. They don't want to rock the boat. They don't want to push rents. They also do not want to take any of their cash flow away and invest in the property. So they're not doing tenant improvements. They're not, sometimes, unfortunately, they're not keeping up with maintenance, but they certainly are not doing tenant improvements. And so it's a pretty easy situation to come in. We've got tenants that'll come in and they need a specific build out. And if they're willing to pay the rent for that, we'll do it. And we underwrite that on the front end. So we'll reserve a lot of tenant improvement money, leasing commissions, renovation money, and CapEx money on the front end. And so we're not having to pull it out of cash flow. And it behooves us to spend a little money up front to get a higher rent that helps us on our exit.
Yep.
So,
That makes
yeah.
sense. And when you're talking with the owners, is it like one of the reasons I like self storage and RV parks so much is that of the commercial assets, I find that they're most owned by mom and pop owners. Like you can find a good deal because a lot of them are mismanaged.
Yeah.
On the industrial side, it seems like there's a lot of institutional owners, and it's more difficult to find a mismanaged property. Is that the case with Flex, or are there a lot of mom and pop for Flex as well?
It depends on the size. So our sweet spot is probably say $5 to $8 million purchase price, and there
Mm.
are a lot of mom and pop owners in that space.
Mm-hmm.
Once you start getting up to the 100,000 plus square foot properties, you start getting into more sophisticated and potentially institutional assets. However, that's not to say there's not some value to be added to those properties. Not every sophisticated, complicated owner is good at managing the properties, first of all. We purchased a couple of properties from a REIT earlier this year. And the properties were impeccably maintained. I mean, these had newer TPO roofs. Everything was new resurfacing of parking lots, and these were concrete tilt wall construction assets. So everything was impeccably maintained, but they are less likely to push rents as well. Like their asset managers are more concerned with
high occupancy versus maximum.
So you got to have some guts to stand up to some of these tenants sometime and say, no, this is the new rate. And some of them, sometimes they'll leave, and you just have to stomach it out till the next guy comes along. But we believe so much about the supply and demand imbalance in this asset that we're calculated with that. Of course, we know that particular market and even that sub market within the market before we make play chicken with a big tenant. But oftentimes, we've had some leave, and that's fine, because then we get to re-tenant it, and we've underwritten in our models 6 months on the turns, and tenant improvement and leasing commission. So all that money is sitting there ready to re-tenant it. Obviously, returns look better if the tenant stays, and we don't have to spend all that money. But it works both ways sometimes.
Yeah. One of the other things that kind of not turns me away from industrial, but I feel like is just a little bit more of a risk, is that there are fewer tenants, and so if somebody does leave, you're kind of screwed. You're not screwed, but there is a cost to it. Is there a certain, when you look at properties, do you want a certain number of bays and a certain number of tenants in there, or like a single tenant? Are you okay with that, or do you want at least?
Not really. We have a couple of single tenant assets, but they are in markets that we have other in parts of portfolios where we have other multi-tenant. Typically, we want a minimum of 4 tenants, and that would maybe be not enough, honestly. So that is part of our whole thesis. Multi-tenancy, same as an RV park or self-storage, you have that vacancy risk mitigation. We're constantly dealing with leases, and tenants are leaving, moving in. It's a constant flow, but cash flow works we underwrite general vacancy just like everybody does, just like you do in self-storage or RV park. You underwrite a vacancy. So we, probably one of the biggest differences, though, Gabe, is the complexity of the leases, right? So every lease negotiation every lease activity turns into a negotiation. There's so many different terms. The bigger the tenant, the more intense the leases become. If you're dealing with a FedEx or a CVS, or they have their own lease forms. It's a long process, and that's where our commercial real estate background, specifically my net lease retail, it's a little different than the industrial, but that's where that background is very helpful. But so it's not like a storage lease. It's a one pager, and everybody's on the same lease, sign it or don't, and it renews every 30 days. It's not like that. You're dealing with 3 to 5 year leases. You're dealing with renewal options. You're dealing with CAM. So one thing we love about Flex is almost all of our properties are on a net lease. So we get reimbursed for all of our property
Property taxes,
taxes, insurance, and common area maintenance expenses. But that becomes you've got to calculate that and bill for that, and you've got to make sure it's accounted for in the leasing correctly. One of our biggest issues would be HVAC. No tenant wants the responsibility of HVAC. No landlord wants the responsibility of HVAC. So there's always a dance there in the lease negotiation. And a lot of times we end up with some kind of a in between. Hey, the tenant's responsible for maintenance and repair up to a certain value, maybe things like that. So it's a little more complex, which we feel is a little bit more of a moat around the product than, say, self-storage, where it's a little less complicated of a business to run. So
Yep, that makes sense. You've mentioned supply demand imbalance multiple times. So where do you see the imbalance most heavily affected? Like what cities, and then where do you get the data from? I guess is there a industrial like CoStar that you can see the supply and demand in, or do you just use CoStar?
So yes, CoStar is one source, and for instance, we own a large asset in Louisville, Kentucky, and the CoStar report for Flex Industrial in that market shows a 1% vacancy.
Oh, wow.
So that is very helpful. Now, I will say Louisville is kind of on the larger side of the markets we typically play in. We typically play in these secondary markets: Birmingham, Alabama; Jackson, Mississippi; Little Rock, Arkansas; Pensacola, Florida; the outskirts of Atlanta being a little bit different animal. And when you get into those smaller markets, there's the CoStar data becomes more noisy. It's not as defined. There's just not as, so that's when the local broker knowledge really comes into play. And, we database every property in the market. When we decide to enter a market, we database every property. We're looking at all of the on market comps. We're talking with the brokers. We probably have some improvement to make there to really take that data from more anecdotal data to
hard data.
To real hard data. But I mean, we're working in those markets, and we're boots on the ground. We're going to the markets. We only work in the SEC regions, what we call it, but the Southeast, right? So, we're kind of right in the middle of that. And so we get on the ground in those markets. There's no substitute for laying eyes on the property, laying eyes on the market, driving the market, staying in the market, seeing the traffic patterns, seeing, what's going on in a market. So that's kind of where a lot of the data comes from. And I do want to address your question earlier about development. So there is such a supply and demand imbalance in some of these markets that and part of it is growth. So that's the other thing, is we want to be in at least the submarket where there's population growth occurring. And so you've got growth and no new supply. So that helps with that supply and demand. But there are some that we are starting to see where there's potential for development. But, currently we're $8 to $12 on rents in all of our properties. And you've got to be more like 16 to make that work, which is one reason we're acquiring. We know eventually there will be such a demand that new product will have to be built, and we feel like that will help increase rates across the market. So that's all part of our whole thesis, is that yes, right now it's very difficult to make the rents work, but there are enough cowboys out there. They're going to put some product on the ground at a higher rent, and that's just going to help us achieve higher rents. So.
We do have to move on, but last question that I got for you. I had a guy on the podcast that was in industrial earlier. And when he doing flex, and I always like to ask the question of like, who are the tenants that you're renting to? Because when you're doing smaller industrial properties, I'm assuming you're not going to have UPS, CVS, those big guys in there. So you're going to be renting to, is it like just contractors? Is it, who are your average tenant?
So most of our properties are the suite sizes range from say 3 to 10,000 square feet. So these are not tiny, what I would call contractor garages. These are more true flex, and we do have a lot of a lot of service companies, and we do have
Okay.
we have Terminex in multiple properties. We have Icy for some reason in multiple
Oh,
properties.
I see
Yeah,
the ice company. Yeah.
yeah, we do have a FedExes. We
Oh,
have
wow. Okay.
FedEx and JBM. So we have some last mile logistic companies. We have
Got it.
some.
Right.
We do have CVS and some other pharmacies that are kind of specialty. They're not retail, but they're fulfillment and compounding of some pharmacies. We have some other life science labs, engineering companies, HVAC contractors. It's a lot of just
So yeah,
service,
across the
which is
board. Yeah.
another reason we love it. If you need a warehouse component to your business, you're probably not going to be able to work from home. So
Right.
we feel like it helps to protect us from that movement as well. So yeah,
Makes sense.
so that's kind of a good idea of who all the tenants are. So
Awesome. Well, I'm going to take that opportunity to move us on to the quick question round. Are you ready?
all right,
Let's
let's
do
go.
it. I
Let's
gave you
go,
a heads up
Gabe.
on this one already, so you should be ready. It's about education. I need two recommendations. It could be books, could be movies, could be Netflix shows, whatever. Just give me two recommendations. One for general life wisdom and then one for real estate.
So general life wisdom, it's pretty easy. I would say, we named our company Stoic Equity Partners for a reason. We believe in stoicism, and I mean, I will point out I'm a Christian, not a Stoic, but do believe in
It fits
stoicism,
into
and
every religion. Stoicism is agnostic.
ex- exactly. And so we are, if there's ever anything that could come up, it's going to come up in a real estate transaction, and you have to. It, it's not about what happens, but how you react to it to help you achieve your ultimate goals. And so, long story short, but I would say probably "The Obstacle Is the Way" by
Mm,
Ryan Holiday is a
yeah.
book that I've leaned heavily on for years now. So that would be general life, and then as far as real estate goes, there's a book that's private equity investing in private equity real estate by wow, I hate to do this. I'm gonna look real quick on Amazon, but because I want to give him credit, I think it's an amazing book.
So
Um,
while you're doing that, of the Stoics, which one is your favorite author, I suppose?
Probably Marcus Aurelius. I keep revisiting.
Meditations.
Um, yeah, keep
Yeah.
revisiting meditations, and I guess mainly because this guy he was adopted, became the emperor of the world essentially at that time, right? Became the most powerful man in the world, and yet he took time out every day to sit and think and ponder and write to himself about how to be a better human. And I just think that's an amazing lesson.
Yeah.
Um, and he was writing to himself, and just we're lucky that it survived, and we can read it. So
Yeah. Yeah, that is
um,
Meditations is one of my favorite books because it's like you can pick it up. I call it the toilet books. You can pick it up on the toilet, read for like 5 minutes and get exactly what you need out of it and then put it down. You don't have to put, an hour into it to go through a story. It's just these little snippets that give you good little gems of wisdom and then you can move on.
yeah, Yeah, it's definitely a good one. It's not the easiest reading material out there, but it's a great one. But the other for real estate is Investing in Real Estate Private Equity by Sean Cook.
There you go.
And it's if you've never read it, it's very concise. It's very it's written from an investor's point of view, and it kind of explains the whole industry, and it's fantastic. My One of my sons has read this, and he, he'll get into talking to me about the capital stack and how we're doing certain deals, and it's a great book. It really is a good book. I've given out many copies of that book.
And you said that's by Sean Cook?
Sean Cook, Sean Cook. Yeah.
Perfect.
So
Good recommendation. All right, moving us on to the next question. This is for your younger self. Let's go back to the Jeremy, who was still a bond broker way back when. Go back to him, look him in the eye, give him one piece of advice moving forward.
I would say don't get into the home building business during the recession, but honestly, that construction background has been very helpful to me now, and so I'm not going to say that. That's That's a really good question, Game. I um, hmm. Over the years, I've always thought I would probably tell him to not get out of the bond business. I was of the age where, I just felt like success was easy to come by here anywhere. I had a lot of success in the bond business, and I guess I was naive enough to think I could translate that to anything else and make it work. And there's been many times where I've thought I should have just stayed in the bond business. So I think that's probably what I would tell myself.
That's funny. All right, next question. We've kind of alluded to this already, but we're gonna whittle it down to a single market. The United States is a huge place. There's tons of opportunity out there. Give me the single metro you're most excited about investing in today.
This may come as a shock, but Jackson, Mississippi, which Jackson
Mississippi.
is
Interesting.
Yeah. So Jackson, the Jackson proper is maybe not the greatest market, but the MSA, and you've got several great growing suburbs and markets, but AWS has recently announced a new $20 billion data center in Jackson.
Wow.
I say 20. The official announcement's $10 billion, but everyone I'm talking to is saying the project's already up to 20 billion. And the amount of tailwinds in that market is amazing. And what I learned recently is that it's at the intersection of two of the largest dark fiber lines in the country. And so there will probably be more phases to that data center, as well as other data centers in that market, just because of the amount of capacity. And we all know what's going on with AI and the need for data centers, and Entergy has a lot of power they can supply them there. So I think there's just a lot of tailwinds in that market, and it's been kind of a sleepy market to date. And so I'm really excited about that market and what's going to happen there.
That's interesting. I've had residential, like single family houses sent to me from wholesalers in Jacksonville, and they're like $5,000, $10,000. It's crazy. It's a pretty low. I would consider it to be a rougher market, but if Amazon is putting $20 billion into it, there's definitely something to it.
Well, now to be clear, that where you're talking about in Jackson proper, in Hinds County, it's like it can be very rough. And however, north in Madison County, where AWS is building their data center, and it's a little suburb called Canton, it's a good bit north, and you've got some very very nice markets up there: Ridgeland, Madison, Gluckstadt. South of Jackson, you've got Richland and Pearl and some other good areas. So, yeah, I'd be careful about buying those $5,000 homes in Jackson proper.
I don't buy single family, but I always
I
thought
I definitely would not go collect rent there. Let me put it that way. So I'd probably not invest in it. So
fair enough.
But around Jackson, to be clear.
Yeah, makes sense. All right, second to last question. This is about lessons learned. Not every deal that we get into goes the way that we expect it. In fact, pretty much every single deal, there's going to be something that kicks you in the face and the deal goes a little sideways. But that's when we learn our greatest lessons. So what was a deal that went a little sideways for you? And then what was the lesson you pulled from it?
Okay. So, I'm embarrassed to say this because my construction background probably should have identified this earlier, but we had a large tenant in one of our spaces, a new tenant in one of our spaces, and we all decided on some tenant improvements and build out, signed a lease, and we started the construction and found a column right in the middle of what was to be their showcase training room, conference room. And we tried as much as we could to maybe put some other columns in and bridge it and do a bunch of stuff. And financially, it would, obviously you can do anything. It's just how much does it cost? So it just financially wouldn't work. And we worked tirelessly with the tenant. We finally came up with a whole new floor plan, did all that. It still was going to cost more. We had to eat some of that expense, but they ultimately re-upped a longer lease at a higher rental rate to get what they wanted. And we now have a very nice, deep relationship with that tenant. So I guess the lesson learned, check for load-bearing columns in the middle of the conference room or, in the walls, but get above the ceiling and look at that stuff. But mainly it was back to it's how you react to it. We worked diligently with the tenant, and we ultimately got them what they wanted, and actually in a form that they liked better than the original plan. And we're able to form a deeper relationship with them. So
there you go.
Yeah.
The lesson: don't throw your hands up. Just keep working.
Just put your head down and work.
Yep. I love it. All
right.
That leads us to the very last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. That's a two-parter. Where can they find you? And then what can they expect when they reach out? So
probably the easiest thing to do is find our website. That's stoicep.com. So STOICEP, which stands for equitypartners.com. And there it's got all my personal contact information as well as all our socials. And we're pretty active on LinkedIn and some socials as well. We are currently raising for a fund. So anybody that wants to reach out and thinks that they want to be an investor in our passive deals, we would love to talk to them. But as you can tell, I'm a real estate nerd and I just love to talk about it. So, I'm pretty free with advice. It's worth what you pay for it, but I am open and willing to talk with anybody who, if they're getting in the business and want to get, understand something or have questions or want to know how we've done this or that and how we've done things that we don't want to do again. There's a lot of experience that we've gained in the last few years. So, yeah.
Perfect. I will put that link in the show notes. So if you guys want to reach out to Jeremy, just click the little more in the description. It'll pull down that full description, and in there you can find his link. All right, man. That wraps it up. Thank you very much for the show.
Yeah, thank you very much. A lot of fun. Have a good one.
Absolutely. For everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions at all, reach out to me, Gabe at therealestateinvestingclub.com. If you want to support the show, just give us a review on Apple or Spotify or whatever you're listening to this on. Other than that, I hope you guys have an absolutely fantastic week. Keep rocking real estate, and I look forward to seeing you on the next episode.